All right, everyone, welcome back. We got the World Economic Forum. We got Brad Garlinghouse. We have Brian Armstrong on stage with three other people. Tokenization is the future. There's a lot of back and forth here. If you missed part one, go watch it. This is part two. Let's jump into this conversation. It is getting zesty.
There's no one's throwing democratization of the market to me. And that's typically the argument when we have some sort of innovative approach to an asset class. Valerie, do you want to come in on this and the perspective that you have? Because today, as we talk about real world assets, there is a huge switch towards alternatives. And you're looking at what that means in terms of access to some of those products.
Absolutely. And frankly, coming back on the point on trust, we just wanted also to bounce back on that. I think also as the market mature, I mean, people are looking also for, trusted party who can really continue to bring safety for the market. But they're also looking for institutions which are bridging different zones, different pools of liquidity. And this is where a financial market infrastructure starts playing a role, because indeed we need to first see how the market is emerging. But then when we are starting to reach a certain level of maturity, then indeed having a financial market infrastructure which can allow interoperability between different pools of liquidity, but also with the traditional finance has a lot of value. And to come back on your point about alternatives, it is indeed correct that the market is in search of investment products which are meeting more their needs. Maybe sometimes traditional finance has not evolved sufficiently fast to really attract those investors. And I do see as well tokenization, but also alternative, to be a way to increase the attractiveness of the European capital markets. Typically, we know that we have lots of European savers, but not investors. And having instruments which are really addressing their questions in terms of risk profile, but also in terms of access, ease of access, will certainly be good as well for the European capital markets. So alternative tokenization, as you were saying, complementarity between the Bitcoin and the traditional finance, I think all of that, is good for the growth of the financial markets.
The attractiveness of the asset also in some parts comes down to yield. And it's funny, gold's been so attractive, but doesn't pay a yield. There's a fight brewing stateside around regulation. And I know, Brian, you've had issues with the Clarity Act, and now it's stalled thanks to some of your opposition. You've been talking about whether there should be a reward for some of these tokenized assets, almost like a dividend. Just explain that notion to us, because the Chinese are pushing ahead with the revamped yuan that pays some sort of a dividend. Why is it necessary in your view? Is it just pushing the agenda for Coinbase, or is it good for consumers?
That's a great question.
Legislation in the U.S. has been making good progress on market structure, and I wouldn't say it's stalled. I'd say there's a good round of negotiation happening, and so I think that that's positive. What we shared publicly was that we want to make sure any crypto legislation in the U.S. does not ban competition for traditional financial services, banks, or traditional securities brokerages, and in our reading of the draft, that's what it did. It actually unfairly penalized crypto companies. We think they should be able to compete on a level playing field, and when there's competition, that's how the consumer benefits. And I think there's very forward-thinking bank CEOs like Bill Winters and others that have just really been leaning into this as an opportunity. They recognize change as, you can think of it as a threat or you can think of it as an opportunity. So the smartest bank CEOs are leaning into this. Some of their lobbying organizations in DC are trying to put their thumb on the scale and ban their competition, which I have zero tolerance for. So we're going to speak up if we ever see that happening. But yeah, I think there's two main reasons why, in this case, the main debate is around stablecoins paying rewards. First, it just puts more money in consumers' pockets, right? So I think people should be able to earn more money on their money, right? That's the high level. It's also about global competitiveness, though, like you said. China did just come out recently and say that their central bank digital currency is going to pay interest, okay? And then there are offshore stablecoins that are actually larger than the U.S. regulated ones right now, and they would love it if U.S. stablecoins were banned from paying rewards, because it allows them to flourish offshore. So we need, from a U.S. legislator point of view, they should be ensuring U.S. regulated stablecoins are competitive. Same thing from a European stablecoin point of view. I hope Eurocoin and et cetera continues to grow. And we're in a global competition. We need to make sure that consumers benefit, and each country puts their interests first.
Governor, to that
really quickly. So what you're having here is what Coinbase's position, at least how I understand it, is that some parts of the bill limits what Coinbase is able to do. And some of the areas that Coinbase has expanded in to offer consumers access to different products, different yields, would be banned under specific rules around the Clarity Act. That's why Coinbase pulled their support. That's how I understand it. Now, if you understand it differently, let me know down in the comments. But what's important here is the banks are coming in and they're putting their thumbs on the scale and they're trying to get rid of their competition before they actually have to compete at scale. They're also worried about money flight, right? So right now, a lot of people have their money in the bank, but if over here, there's this new regulated market where you're getting an extra 2, 3, 4%, right? And it's all regulated, you might go to where you're getting the best return for your money. Because if you're just holding that, if you're saving that, and you're getting 1/4% or 1/10% at whatever bank, and you're getting 3 or 4% from Coinbase or Uphold, of course you're going to choose the 3 or 4%. So they're worried about that money leaving the banking system, and they're worried about if that money does leave the banking system, how can they loan and do all of these extra things that banks do to, stay in business.